Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik and this is episode 13 of my Dow Analysis series in which we'll be analyzing every single company in the Dow Jones Industrial Average. So in this video, we're going to be analyzing the 12th smallest company in the Dow by market cap, and that is Intel Corporation, ticker symbol INTC. So most of you guys probably know Intel has been facing some challenges over the past few years, and as a result, the stock price has definitely taken a beating. So I think this is going to be a really interesting one to look at their business and see how they are really doing and see if this drop in stock price is really warranted. If you find value in my videos, make sure to like and subscribe so you don't miss out on future content. This is Frank Mularcik. So first of all, looking at the 2021 10K report, just want to go through their business segments and talk a little bit about what they do. Most people probably have a good understanding of what they do. They just manufacture semiconductor devices. So lots of computer CPUs is probably the most well-known thing, and that's where they have most of their revenue, but some other areas of semiconductors as well. So the first segment is the client computing segment, which makes up about 51% of their revenue, and this includes platforms designed for end user form factors focused on higher growth segments of 2-in-1, thin and light, commercial and gaming, and growing adjacencies such as connectivity and graphics. So obviously that's about half their revenue right there, and this is probably what most people are most familiar with when it comes to Intel. Then about 33% of their revenue comes from this data center group, which includes workload optimized platforms and related products designed for cloud service providers, enterprise and government, and communications service providers market segments. So essentially just data center stuff for the most part, which is vitally important for sure. And then the next segment is Internet of Things, which is about 5% of their overall revenue. And this includes high performance compute solutions for targeted verticals and embedded applications in market segments such as retail, industrial, and healthcare. I think this Internet of Things segment has a lot of potential in the future, and I think it's just going to grow a lot more as that becomes a lot more prevalent in every industry really. The next segment here is Mobileye, which is about 2% of their overall revenue, and it includes comprehensive solutions for autonomous driving, including compute platforms, computer vision, and machine learning-based sensing mapping, localization, driving policy, and active sensors in development, utilized for both robotaxi and consumer level autonomy. So that is pretty interesting. Obviously, it's a very small portion of their revenue right now, but obviously there's a ton of room for growth there if they're able to see some more success with this segment, I think. And the last, not the last one, sorry. This one right here is Nanoscale Group, Nano Memory Scale Group, or something to that effect. And this includes memory and storage products primarily used in SSDs. And then the last segment here is the programmable group, which is about 2% of overall revenue and includes programmable semiconductors, primarily FPGAs and related products for communications, cloud and enterprise, and embedded market segments. So that's kind of an overview, of those business segments and what they do. They do have a ton of super detailed information about all these segments and their earnings and results and revenues and all kind of stuff like that, which I think is super interesting and helpful. And we really don't have time to look at all of that right now, but we're just going to scroll down here and look at the overall results from 2021. So the main thing to look at is the top line, I think, which is about $79 billion worth of revenue in 2021 compared to about 78 billion, almost 78 billion in 2020. So just a little bit of growth there, a few percent, not a ton. And 2020 was a little bit of growth over 2019. And then where it starts to look not quite as good is when it comes to income. So income was about $20 billion in 2021 compared to about 21 billion in 2020. So that's not the best thing to see. When it comes to earnings per share, that's not as big of a drop because they did repurchase some shares. So about 486 earnings earnings per share compared to 4.94 in 2020, and that's expected to go down, as we'll see. That's expected to go down significantly in 2022, but those are kind of the results for 2021. Another thing that I saw in the 10K report that I wanted to mention was that they are building new plants in the US. So they're building one in Ohio near Columbus for manufacturing, and also they're building another plant for manufacturing in Arizona somewhere. I'm not exactly sure where that one is. But that's definitely a good sign that they are, investing into the U.S., into new manufacturing. Obviously, that means they think that those are going to be a good investment overall. And the other thing that I did want to mention was the share repurchases. They still are repurchasing shares, but it's at a much lower level than previous years. I think, in maybe 2019 or 2020, they were repurchasing somewhere in the range of $5, $10, $15 billion worth of shares, where in 2021 they only repurchased about $2 billion worth of shares, and they're expecting that to be the trend, at least for the next couple of years, that they're not going to have nearly as much in terms of share repurchases. The next thing we're going to take a look at is the first quarter earnings from 2022. So these are a little bit more up to date, I guess, than the 10K. And the first thing to note, again, revenue is down for the first quarter of 2022 compared to 2021. So on a non-GAAP basis, about $18.4 billion of revenue, which is down about 1% year over year. And that actually exceeded January guidance, but still a drop year over year. And then first quarter non-GAAP EPS was 87 cents, which also exceeded the January guidance by 7 cents. But again, I think that is down significantly from 2021 first quarter. And the other things, so yeah, we can actually see that 87 cents compared to $1.34 in 2021. So that's about a 35% drop there. And I think they talked about individual segments. Yeah, so the client computing group, which we just talked about, is about 50% of their revenue. In 2022 first quarter, this revenue was $9.3 billion, which is down about 13%. And one of the big reasons for that is because of basically Apple. So, a lot of Apple computers for a long time had Intel CPUs in them, but then Apple basically came out with their own CPU, the M1. I think they might even have an M2 now. So Intel basically lost a lot of business there, and they said that was one of the big reasons that the CCG, or Client Computing Group, saw a fairly big drop, 13% drop in revenue, whereas all the other segments saw pretty much double-digit growth in revenue in the 20% range, which is pretty awesome to see. And in terms of guidance for the full year 2022, they're expecting about $76 billion in revenue, which is about $2 or $3 billion less in revenue than they had in 2021. And that's definitely not a good thing, but I think it does show some promise, because like we saw, they're losing revenue from Apple there. And so that is affecting them in 2022 some still. And so, they're losing, say, 13% of revenue from half of their revenue. But the other, segments of their business are growing revenues quickly. And so that is able to make up for that lost amount of revenue. And I think that is a positive sign and shows that the other segments of their business are growing quickly and have potential to transform the business to a degree. And when we look at earnings per share, that is projected to be around $3.60, which I think is around a 32% decrease year over year. It would be. So if they had $3.60 of earnings per share in 2022, that would be about 32% decrease from 2021. But that $3.60 is actually a raise in guidance. They raised that from $3.50, which they had put out towards the beginning of 2022. And looking at the balance sheet from the end of Q1, their current assets are sitting around $62.5 billion, which is up about $4 billion from the end of 2021. And we can see some of the differences here. They have a little bit more cash than before, and they have about 50% more short-term investments at this point in time than they had at the end of 2021. And when we look at the current ratio, which is basically current assets divided by current liabilities, we see that their current ratio is very healthy. Current assets around $62 billion, whereas current liabilities are $29 billion. So that means the current ratio is basically above 2, which means they have twice the current assets than current liabilities, which is a very positive sign for the balance sheet. And in terms of total assets, around $176 billion compared to just a few months ago, $168 billion. So again, good thing to see there. And when we look at total liability, they don't list the total liabilities number, but it's going to be about $73 billion or so, which leaves stockholders' equity of about $103 billion. And if we want to look at the debt to equity ratio, we can look at the debt here is about $33 billion, and then they have about $4.5 billion of short-term debt. So that gives them around $37 or $38 billion of debt. And comparing that to their equity, which is $103 billion, that, say $38 billion divided by $103 billion, that gives us a debt to equity ratio of around 1/3, which is, in my eyes, that's a good thing, because it means a lot of their investments and growth are going to be financed through stockholders' equity rather than debt, which I like to see a little bit more in a business. So a few of the companies that I've analyzed over the past few months on this channel, I've consistently said I think I would like to see some reduction in debt more aggressively than they currently are. But I think Intel is one that I wouldn't say that for. I think their balance sheet is very strong, and their debt is just fine where it's at right now. So next, just looking at the dividend information for Intel, they currently pay a dividend of $1.46 here, which gives them a dividend yield right now of 3.9%, which is pretty awesome for any company, let alone a company in the tech sector, because tech companies tend to not pay dividends or have much lower yields. And another great thing to see is this payout ratio below 30% is really fantastic given that high yield as well. So that low payout ratio means they do have a lot of room to grow the dividend. Unfortunately, they haven't really been doing that super consistently. They do have 8 years of dividend growth, but over the last 5 years, they've only grown the dividend around 6% per year, which is definitely a decent amount. But for a tech company, I would definitely like to see a lot more. Over the past 2 or 3 years, I think it's been pretty much about exactly 5%. And they have been paying dividends for a lot longer than 8 years, but they paid the same amount in 2013 and 2014, so that growth streak per se got reset a little bit. So overall, I think they have a strong dividend, and they certainly are going to have no trouble paying the dividend, but I would just like to see a little bit more growth, I think, out of the dividend. And the next thing we are going to look at is the PE ratio here. So I sort of took some historical data of the PE ratio and put it in this spreadsheet, and we can see this chart here is the PE ratio over the last 10 years, 12 years basically, since the beginning of 2010. And over that time period, the average PE was about 11. And if we look over the past 5 years, the average PE was about 12. And compared to the current PE, which is about 6, right now, the stock looks a bit undervalued, I would say. And we can look at the EPS as well. And generally, it's been growing. They had some nice growth in 2018. It's been a bit stagnant since then, and they're probably going to see some declines over the next few quarters, which is definitely not good to see. But I think in the long term, they can recover in terms of the earnings, and hopefully bring those numbers back up, above $4, $5 per share would be awesome. In terms of PE ratio, I think they are a little bit undervalued. And if we compare them to their peers, the overall tech sector has a PE ratio of around 21, and this hardware industry, which they are in, has a PE of around 17.6. So they're definitely undervalued compared to the industry as well, which is another positive sign to see. So when we look at the discounted cash flow calculation, it does get a little bit interesting. So over the past few years, their free cash flow has been changing a lot. We can see in 2020, they had over $20 billion of free cash flow, but in 2021, they had less than $10 billion. So it hasn't been super consistent. So that makes some of these calculations a little bit hard to predict. But I tried to go a little bit on the conservative end when it comes to, free cash flow estimates. And when we complete the calculation, we come up with a fair value of $42.51. And if we apply a 10% margin of safety to that, we get a buy price of $38.26, which is pretty much right in line with the current price of $38.45. So, from the DCF perspective, I would say they are pretty much near their fair value, a little bit undervalued. But in terms of, this specific calculation, it doesn't look drastically undervalued. But again, I would say that I was pretty conservative with the free cash flow estimates. And so if I was tried to be a little bit less conservative, we might see some much better numbers for this calculation. And looking at a chart of Intel is pretty interesting as well. So right now we're looking at a 10-year chart, and you can see really not a ton of growth in the stock price. And what I find pretty interesting is they have a pretty strong level of support, it looks like here at $43, that until recently they hadn't really been below since the end of 2017. Basically, they hit it in 2018, again in 2019. They basically hit that support in the March 2020 drop. They hit it again later in 2020, and then they finally hit it a few times here in 2022, and finally at the beginning of June broke below that support. So I think that's a little bit of a bearish sign for the stock in general from a technical perspective. But if we look a little bit closer at the 1-year chart, obviously just pretty much straight down on the year, and they have a little bit of volume in this range, but really not that much. So it'll be interesting to see what happens from here. The one thing I guess that I didn't explicitly mention on the 10-year chart that you could see is they're actually below March 2020 prices at this point, which I think is extraordinary to see that. Like, not many companies are below March 2020 prices at this point. So that's pretty interesting, and I think that in and of itself offers a pretty good opportunity for Intel stock. So before we are done, I just want to open up this spreadsheet here, if it will open for me, which is just the companies in the Dow, and check off these last two. So Amgen from the previous video, if you haven't seen that one, you can check it out. And then Intel, this video we made just now. So the next company we'll be analyzing is Salesforce, ticker symbol CRM. So definitely look forward to that one. In terms of my overall thoughts on Intel, I think it is a great company, and they have a lot of good products that are widely used and are essential to our world today. So that's definitely a good sign. The revenues, they are growing but very slowly, and earnings over the past few years have been growing slowly, and now they're starting to drop off some the past few quarters, and they're going to continue doing that for the next few quarters, which is definitely not a good sign to see. But they are in a sort of transitory moment for the company. They're trying to make a bit of a pivot and turn around their business with the new CEO, Pat Gelsinger. So I think it's going to take time, and it's definitely not an easy process, but it's definitely something that has a lot of uncertainty involved with it. In terms of the balance sheet, I think the balance sheet is probably one of their strongest points, I guess, in my opinion. I just think it looks really strong. And I think the dividends are fairly strong as well. They have a higher dividend yield and a low payout ratio, which is a super good combination. Unfortunately for me, the dividend growth that I want to see really just isn't there. And in terms of valuation, I think they look, undervalued from pretty much all perspectives. So, I think overall Intel is at a pretty good price right now, and it could be a pretty good opportunity. But for me personally, I'm not going to be buying because I just don't see the potential for lots of dividend growth at this point in time. I think, maybe 5, 10, 15 years in the future, they could have a lot of dividend growth. But at this point, I'm just not knowledgeable enough about the company to be confident in any sort of predictions that far out in time. So I guess for that reason, I'm not going to be investing. But I'd love to hear your guys' opinions about Intel in the comments down below. There's definitely a lot of interesting things going on with the company, and they've had their fair share of challenges and are trying to adapt over the last few years. So overall, I think they will eventually recover and do well. It's just a matter of when and how much. So thanks for sticking around to the end of the video. I really do appreciate it. Again, let me know your thoughts down in the comments below, and I'll see you in the next one.